I have been successful in purchasing tax liens on the secondary market. So what does that mean? So there is a pool of investors that purchase tax liens in bulk, right? They hold these tax liens for a specified period of time, and they release that population to a selected group of individuals for investment opportunities, right? So they're sort of like institutional investors. These are banks and financial institutions that are holding tax liens that don't necessarily want to be at a position of holding that tax lien when it reaches a point of redemption. So basically what they do is they put these tax liens on the secondary market, and they allow individuals like you and I to come and invest in that portfolio and make money from it. So that's how I initially got into tax lien investing. I did purchase some tax liens, direct tax lien certificates at the county level, but my initial experience was definitely secondary on the secondary market.
Ooh, so I have all sorts of questions for you. But I do know another tidbit of information you told me is that you purchased one by using your credit card and then redeeming it. Not that we're telling people to go into debt to buy these, but I thought that that was a very interesting story. You said that was a way you used debt in a good way in order to, build additional wealth for your family. So let's take a step back then. What's a tax lien? What are we talking about here?
Yeah, so so by definition, a tax a lien is a claim against an item, right? Which affects the ability to transfer ownership to another party. It utilizes a security for a repayment of a loan or a claim, and property taxes are one of the most common types of tax liens out there. So they are defined by the county's ability to assess the value of that property. They're also defined by county boundaries. Most um, uh, governmental entities are separated by county, right? So what one county is doing, another county is not doing. So every piece of real estate is subject to property taxes, be it a physical structure, vacant land, raw land, land with buildings on it, commercial properties, what have you. And so those pieces of property is subject to property taxes, and the tax rate for each property is based on a combination of, like I said, the property value and the county's estimated budget for the year. So that's why the assessed value, the county value, may be different than the actual appraised value of that particular property. So what happens? Everyone has to pay property taxes, right? So when a homeowner does not pay their property taxes, the county has to sort of figure out another way to receive money so that they can keep operations going in the meantime, to give the homeowner additional time to pay the property tax bill. So let's say if, for instance, a homeowner owes property taxes in the amount of $500, the county will issue a tax lien certificate that holds a value of what the homeowner owes in property taxes, and they will allow third parties to come in and purchase these tax liens, right, at face value. So basically, what does that mean? That means that the county is going to, they basically create a system that helps them to sustain operations in lieu of payment from the homeowner, right? That's in essence is what a tax lien certificate is. It's basically a piece of paper that says, okay, this person owes property taxes. Here's the description of the property. Here's the amount that they owe. Here's the deadline in which they have to come back and pay the money in order to not lose their house. So that in essence is what a tax lien is.